Welcome to Iron Financial, where we stress test market hype to find the steel underneath. We don't follow the herd, we inspect the foundation. Our job isn't to tell you what to buy, but to give you the tools to analyze the framework of a company and decide for yourself if it's built to last.
Today, SIFY Technologies is on the anvil. You've heard the story, and it's a good one. India's AI revolution is happening right now, and every revolution needs infrastructure. SIFY is selling itself as the premier provider of that infrastructure, the picks and shovels for a massive digital gold rush. So the question we're hammering on today is simple but absolutely critical. Is this a solid steel foundational investment, or is it just a thinly plated liability ready to crack under the first sign of pressure?
And let's be real, the pick and shovel story is always tempting. It sounds safer, right? You're not betting on a single gold miner, you're betting on the whole industry. But here's the catch. If the company selling those tools bought them all on credit and they aren't even making a profit, then it's probably the fastest way to lose your shirt. So today, we find out if SIFY is a tool maker or just a debt maker.
All right, before we can even begin to assess SIFY, we have to understand the ground it's built on. And that ground is shifting. India is smack in the middle of a full-blown AI gold rush. This is a technological arms race that demands a digital foundation on a scale we've never seen before. We're talking every startup, every major corporation, every government project. They all need immense computational power, lightning-fast networks, and secure data centers to even get in the game. This is the tidal wave SIFY plans to ride.
And the numbers fueling this wave, well, they're staggering. This isn't just some small incremental increase in demand. We are looking at a projected demand specifically for AI that will require 1.1 gigawatts of data center capacity by 2030. Now, to put that into perspective for you, that's enough juice to power a small city. That is the sheer scale of the opportunity here. It's a monumental build-out, and you better believe the companies that lay the concrete and string the fiber for this new digital city stand to make a fortune. Okay, 1.1 gigawatts is a huge number. It looks fantastic on a presentation slide. But a big pie just attracts a lot of hungry players. That demand doesn't just magically flow into one company's bank account. So the real question here is whether SIFY is actually positioned to capture a meaningful slice of that pie, or if they're going to get pushed out of the way by leaner, more aggressive competitors. The size of the prize doesn't matter one bit if you can't get your hands on it.
And that's a fair challenge. So let's bring SIFY into the forge. Now, this is not some flash-in-the-pan startup. SIFY was founded way back in 1995. They were actually the first Indian internet company to list on the NASDAQ. So they've been laying digital pipes for decades. They're not just chasing a trend, they helped build the original foundation. And now, they're positioning themselves as the master forger of India's new AI backbone, claiming they have the experience, the footprint, and the tech to be the only provider anyone needs.
And as you can see here, SIFY is not a one-trick pony. They're not just a pure-play data center company. No, they're an integrated ICT solutions provider. Look at these pillars. Data centers, intelligent networks, cloud and AI, cybersecurity, and managed services. They offer the whole shebang, from the physical building that houses the servers all the way to the software and the security that runs on them. This is their core pitch. They're a one-stop shop for any enterprise that's serious about going digital. You know, an integrated model can also be a fancy way of saying they lack focus. A jack of all trades is very often a master of none. So are they truly best in class in every single one of these categories? Or are they just kind of average across the board? Spreading your resources too thin is a classic way to fail, and we need to figure out if that's what's happening here. Is this integration a competitive advantage, a moat, or is it just a complex structure that's hiding some serious weaknesses?
Well, this right here might be the answer. This NVIDIA DGX Ready certification, it's a game changer. Let's be clear. NVIDIA is the undisputed king of AI chips, and their hardware runs incredibly hot. This certification is proof, hard proof, that SIFY's facilities can handle the extreme power and cooling that AI demands. We're talking up to 130 kilowatts per rack. They're using cutting-edge stuff like direct-to-chip liquid cooling. This isn't just about keeping up with the competition. It's about building a high-tech, capital-intensive wall that most others can't climb. They are building for the future of AI, not just for today.
Okay. A long history and a really nice story. Serving 10,000 businesses sounds great, and yeah, that heritage gives them some credibility. But let's be blunt, in the tech world, history doesn't guarantee future returns. You know who else had a long history? Blockbuster Video, Nokia. The market does not care one bit about what you did yesterday. It only cares about your future profits and whether you can adapt. So it's time.
Time to stop looking at the pretty marketing quotes and start looking at the cold, hard numbers on the balance sheet. It's time to see if this structure can actually handle the weight of its own ambition.
Exactly. The story is compelling, I'll give them that. But the numbers don't lie. So now it's time to put Sify's financials under the microscope. We're going to strip away all the marketing narrative and subject the raw data to a serious financial stress test. We're looking for either solid steel or hairline cracks. Let's get into it.
The very first test for any growth story is momentum. And as you can see right here in this chart, the revenue growth in their data center subsidiary, Sify Infinit Spaces, is, well, it's powerful. Just look at the numbers. Revenue has more than doubled in just a handful of years, going from about 5,600 million rupees in fiscal year 21 to a projected 14,284 million in fiscal 25. This is not some hypothetical, maybe one-day growth. This is real demand being turned into real sales. This chart right here, this is the engine of the bull case.
Let's put a number on that beautiful curve. That trajectory translates to a compound annual growth rate, a CAGR, of over 25%. So what that means is, on average, their revenue grew by a quarter every single year between 21 and 24. And with year-over-year growth hitting 28% in the most recent fiscal year, the engine is actually accelerating. This is some serious heavy lifting. Their sales pitch is clearly landing, and the market is buying what they're selling. An engine running this hot is a sign of incredible strength. Growth is great. We all love growth. But growth at any cost is a straight path to disaster. It is very easy to grow your revenue if you're losing money on every single thing you sell. So now we need to see if this growth is actually profitable or if it's just a bunch of empty calories.
An impressive engine, I'll give you that, but it's burning cash, not making it. And here it is, the first major stress fracture. We pulled this number directly from their consolidated Form 20-F filed with the SEC. For the year that ended March 31, 2025, the company posted a consolidated net loss of over 784 million rupees. Let me say that again, a loss. So while the top line, the revenues are soaring, the bottom line is sinking deep into the red. Where are the profits? This is the central question of the bear case. You cannot build a resilient backbone for a country if your own financial spine is broken.
That's a fair point. But you have to remember, short-term profitability is often sacrificed for long-term market share. The critical question is how efficiently they're deploying their capital. So, we benchmark them against their domestic peers, and a key metric here is return on capital employed, or ROCE. Basically, it tells us how much profit they're generating for every dollar they invest. At nearly 8%, their ROCE is right there, neck and neck with a huge competitor like Extra Data. Yeah, it's lower than Control S, but it proves they are putting their money to work efficiently. They're reinvesting everything and then some into expansion. That depresses profits now, but it builds the foundation for massive earnings later. This is a classic land grab strategy. Efficient, maybe, but that expansion, that so-called land grab, is being built on a mountain of debt. And this number, also straight from their balance sheet, is the other side of that coin. Almost 35.4 billion rupees in total borrowings. That is not reinvesting profits. That is funding losses and expansion with borrowed money. That is a massive, massive weight to carry, especially in a world where interest rates are rising. This isn't just a little bit of leverage. This is a significant financial risk. If demand slows down for even a second, or if they stumble on their execution, this debt load could become the anchor that sinks the entire ship.
The debt is a concern. There's no way around it. It is the single biggest risk factor here. So, what do the professionals on Wall Street think? Do they see this as smart leverage, using debt to fuel explosive growth? Or do they see it as a critical, maybe even fatal weakness? Let's take a look at the analyst consensus.
Okay, so 7 Wall Street analysts have put their reputations on the line and published official forecasts for Sify. Their average 12-month price target is $22.44. Now, compared to where the stock has been trading recently, that implies a significant upside, over 60%. The professionals who model these companies for a living are, on average, extremely optimistic about where this stock is headed over the next year.
And this isn't just one or two bulls out on a limb. The consensus here is overwhelmingly positive. As you can see, that huge slice of the donut, nearly 83% of the analysts covering SIFY have a buy rating on the stock. That shows a very high degree of confidence that the company can manage its growth, handle its debt, and eventually turn that powerful revenue engine into a profit machine. They're clearly looking past the current losses and seeing the future value of the infrastructure they're building. Okay, but
Confidence from sell-side analysts is one thing. Frankly, they're often paid to be optimistic. What about the people whose entire job is to assess risk and the probability of default? What do the credit agencies have to say about all this debt?
So Wall Street might see the upside, but the credit agencies, they see the obligation. India's CARE ratings gives their subsidiary Sify Infinit Spaces a solid AA stable rating. Now, that's a strong investment-grade rating. It means the lenders believe the company has a high degree of safety when it comes to paying its bills on time. But, and this is a big but, that rating is applied to over 50 billion rupees, that's 5,000 crore, in rated debt. It might be stable for now, but the very existence of a report this size underscores the massive leverage risk we've been talking about. So the rating is a sign of stability, sure, but the amount being rated is a sign of the immense financial burden they're carrying.
All right, the arguments have been made. The evidence, from the company's own filings, from industry reports, from Wall Street, from the credit agencies, it's all on the table. It's time to put it all together. It's time to weigh the solid steel of their market position against the stress fractures in their financial statements. It is time for the verdict.
So here is the final breakdown. The bull case, the steel frame, is built on some undeniable strengths, both macro and company-specific. You have a massive AI tailwind in India providing the lift. Sify has a dominant, established market position with deep enterprise relationships. That revenue growth is explosive, which proves the market demand is real. And their infrastructure is genuinely AI-ready with those critical NVIDIA certifications. To top it all off, Wall Street is overwhelmingly on board. But the bear case, the cracks in that armor, is just as compelling, and it's rooted in cold, hard financial reality. They are not profitable, the company is losing money, that growth is being fueled by a heavy debt load of over 35 billion rupees. We've seen their profit margins actually decline as they expand, and with any massive construction project comes high execution risk. Any delays or cost overruns could be catastrophic, given how much they owe. This is a high-wire act with absolutely no safety net.
So our final verdict is this. Sify is a leveraged stronghold. Let's be very clear about what that means. The company has built a truly formidable market position. They have a real stronghold in India's digital infrastructure space, and they are perfectly placed to capitalize on the AI boom. The strategic position is solid steel. However, the financial structure they use to build that stronghold carries significant, undeniable risk. This is not a stock for the faint of heart, and it is definitely not for an investor who can't stomach volatility. This is a high-conviction bet on future growth and flawless execution. So, the ultimate question for your portfolio boils down to this. Do you believe Sify's powerful revenue growth engine can generate enough cash in the future to outrun the immense weight of its debt? Or will the sheer financial gravity of that debt prove to be too much for the engine to overcome? It is a race between revenue on one side and liability on the other.
And the answer to that question will determine if this is a once-in-a-generational opportunity to own a piece of India's foundational AI backbone, or if it's a classic value trap baited with a great story but built on a weak financial foundation. The potential reward here is huge, but the risk is just as real. Do your own diligence. We've laid out the framework. The final decision rests in your forge.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.